For much of the last decade, speed was the dominant signal of success. Companies that grew fastest attracted the most attention, the most capital, and the most talent. Rapid expansion was treated as proof of strength. In 2026, that definition is being rewritten. Business leaders across the US are preparing for a different reality: growth that is slower, steadier, and far more durable. This shift is not driven by pessimism. It is driven by experience, data, and a clear understanding of how fragile fast growth can be. Slower growth does not mean weak growth. It means growth that can survive pressure. Business leaders have learned that expanding too quickly often creates hidden risks that only appear when conditions change. Higher costs, tighter capital, supply chain disruptions, and shifting demand have exposed how vulnerable aggressive growth strategies can be. Preparing for durability has become more important than chasing short-term acceleration. One of the first changes leaders are making is in how they set expectations. Instead of promising ambitious expansion targets, executives are communicating more conservative outlooks to boards, investors, and employees. This creates room to outperform, rather than constantly explain shortfalls. Expectations are being reset around consistency and resilience, rather than constant upside surprises. Capital allocation reflects this new mindset clearly. Leaders are being more selective about where money goes. Instead of spreading capital across many expansion initiatives, they are concentrating investment in core businesses with proven demand. Projects are evaluated not just on how fast they can grow revenue, but on how they perform under less favorable conditions. If an initiative only works in a perfect environment, it is less likely to be funded. Cost structure is another major focus. Business leaders are redesigning organizations to be viable at lower growth rates. Fixed costs are scrutinized more closely. Variable cost flexibility is prioritized. The goal is to ensure the business remains healthy, even if revenue grows slowly. This makes growth optional rather than mandatory for survival. Hiring strategies have changed as well. Instead of building headcount in anticipation of future growth, leaders are aligning hiring with current demand and operational needs. Teams are being built to operate efficiently rather than expansively. This reduces the risk of painful corrections later and helps maintain morale and productivity over time. Customer strategy plays a central role in durable growth. Business leaders are investing more in retention, service quality, and long-term relationships rather than aggressive customer acquisition. Existing customers provide more predictable revenue and clearer feedback. Strengthening those relationships supports steady growth even when new demand slows. Product development has also shifted. Instead of racing to release new offerings, leaders are prioritizing reliability, usability, and incremental improvement. Products are designed to age well rather than peak quickly. This supports longer customer life cycles and reduces churn, which is critical when growth is slower. Financial discipline underpins all of these decisions. Strong balance sheets, ample liquidity, and conservative leverage are seen as foundations for durable growth. Leaders want the freedom to keep investing through downturns rather than cutting back at the first sign of trouble. Financial resilience allows companies to compound growth slowly over time instead of stalling during disruptions. Scenario planning has become part of this preparation. Leaders are no longer assuming a single growth path. They are modeling multiple outcomes and building strategies that hold up across them. This helps identify which decisions are reversible and which create long-term commitments. Durable growth depends on avoiding bets that lock the company into one narrow future. Technology investment reflects the same caution. Even as companies invest heavily in AI and digital transformation, leaders are pacing these investments more carefully. Spending is phased, milestones are defined, and returns are measured closely. The goal is to build capabilities that strengthen the business over time, rather than chasing rapid transformation that may not pay off. Supply chain and operations are being redesigned for reliability instead of maximum efficiency. Leaders are accepting slightly higher costs in exchange for fewer disruptions. This supports consistent performance, which is essential when growth is modest. Reliability protects margins and customer trust over the long run. Investor communication has adapted to this reality. Business leaders are emphasizing quality of earnings, cash flow stability, and risk management rather than headline growth rates. Investors are increasingly receptive to this message. Many have learned that slower growth backed by strong fundamentals produces better long-term returns than volatile expansion. Organizational culture is changing alongside strategy. Teams are encouraged to think long-term, manage risk thoughtfully, and focus on execution rather than hype. Success is measured by sustainability, not just speed. This cultural shift supports decision-making that aligns with durable growth. Importantly, this preparation does not signal retreat. Companies are still innovating, competing, and expanding. What has changed is the pacing. Leaders are choosing growth they can maintain rather than growth they have to defend. This reduces stress on systems, people, and finances. In a slower growth environment, mistakes matter more. Business leaders are responding by building buffers, flexibility, and learning capacity into their organizations. They want businesses that can adapt gradually rather than pivot violently. Durable growth is about staying in the game long enough for advantages to compound. How business leaders are preparing for slower but more durable growth reveals a more mature phase of corporate strategy. The focus has shifted from how fast a company can grow to how long it can grow. In an economy shaped by uncertainty and tighter constraints, durability has become a competitive advantage. In 2026, the most successful leaders are not those chasing the steepest curves, but those building organizations that can move forward steadily, absorb shocks, and keep creating value over time. Slower growth may attract less attention, but durable growth is what ultimately defines lasting success.